Welcome to The Explainer. Today, we're taking a grounded, stoic look at exactly how macroeconomic forces are literally silently diluting the value of your hard-earned labor. You know the feeling, right? You work longer hours, maybe you grind for that small raise at the end of the year, but by the end of the month, the feeling is always exactly the same. Your money just buys way less than it used to. And here's the thing, the issue isn't just that things magically got more expensive. The real issue is that the value of your labor is being diluted behind closed doors. So let's dive right into exactly how this happens. Look closely at the Federal Reserve's recent household debt service data. Now, this isn't just some dry economic stat. No, this represents the exact percentage of your paycheck that the bank automatically claims before you even see a dime. It's kind of like a silent tax on your labor. Every single time this ratio ticks up, it means a much larger chunk of your sweat, your time, and your energy is being funneled directly to financial institutions just to keep you afloat. And honestly, that brings us to a pretty harsh question we all have to ask ourselves. Is your hard work actually paying off anymore? You put in the overtime, you grind through the rat race, you do everything you were taught to do. But why does your paycheck seem to evaporate faster and faster every single month? When interest rates move up or down, mainstream media loves to throw around complex jargon, basically keeping you detached from the real conversation. But make no mistake, the reality of those meetings is playing out right inside your wallet. Which brings us to Section 1, the interest rate trap, systemic wealth extraction. Let's demystify exactly how this financial system is actually built to profit off your exhaustion. There is a deeply stark contrast at play here. Think about Main Street. Main Street relies entirely on trading time for stagnant wages. It's physical or mental labor in exchange for a linear, predictable paycheck. Then you look at Wall Street and the banking system, and they rely on the absolute, unstoppable math of compound interest. One system requires you to wake up at 6 a.m. and work until your bones ache. The other system, it makes money while it sleeps. If we look at the Federal Reserve's financial accounts data, specifically their Z1 release, you see that a massive, overwhelming portion of total non-financial debt rests squarely on the shoulders of the everyday consumer. The working class is completely trapped in aggressively expensive car loans, mortgages, and those endless revolving credit cards. You have to realize you aren't just borrowing money. You are literally borrowing against your own future time, and you're paying a massive premium to do it. When you actually track the changes in net worth over time, the gap is just staggering. Expanding corporate empires are scaling their wealth exponentially, right? Meanwhile, the blue-collar wallet remains frustratingly stagnant. It's like a giant puzzle where the pieces are raked. The system is functioning exactly as it was designed to function, extracting wealth from those who work for wages and transferring it directly to those who hold the debt. Ultimately, you're caught in this brutal pincer movement. When the Fed raises rates, high interest rates totally crush you on consumer debt. Your credit card minimums skyrocket, car loans become completely unaffordable. But on the flip side, when they lower rates, those artificially low rates secretly steal your purchasing power through inflation. Either way, high or low, the working person who doesn't understand the rules is the one left paying the bill. All right, moving to Section 2, the psychology of debt, deconstructing the system. To actually escape this vicious cycle, we have to step back, look in the mirror, and truly analyze the psychology of money. Based on some incredible research from Magnates Media's exposés on major businesses, we see that corporate empires absolutely thrive on exploiting consumer psychology. They sell you engineered scarcity. I mean, think about the diamond industry. They literally convince the entire world that a common rock was rare and absolutely necessary to prove your love. They sell modern snake oil, using cult-like marketing to make you feel completely inferior unless you buy whatever product they're pushing. And the ultimate goal of all of this? To push you into consumer debt so you just keep spending money you don't even actually have. So to fight back, we have got to redefine compound interest. This is absolutely crucial. It's not just some textbook math equation you learned in high school and then immediately forgot. It is a financial force. It's a weapon. And you either learn to wield that weapon to exponentially build your own freedom, or you're going to spend your entire life paying it out to someone else. There's this brilliant insight from financial educator Nick Invests, and it really hits the nail on the head. It's the harsh, stoic truth of personal finance. If you're paying 15% or 20% annual interest on consumer debt, no investment strategy in the world will save you. You simply cannot outinvest bad debt. No way. Especially in a volatile environment where the bond market is breaking and mortgage rates are jumping all over the place. Trying to earn, say, an 8% return in the stock market while you're paying 20% to a credit card company, that is literally mathematical suicide.
Let's get to the solution. Section 3. The Working Sage Roadmap, your escape plan.
Okay, so now that you fully understand how the system extracts your wealth, it's time to enforce some rigid financial discipline. It is time to shift your position on the board with a concrete escape plan. Inspired by the wealth rules of Nick Invests, here is your immediate 3-step action plan. Step 1. You have to aggressively declare war on high APR debt. You need to view it as a total emergency. Step 2. Leverage current cash rates. Keep your emergency funds parked in high-yield savings accounts or short-term treasuries so your cash actually beats inflation. And step 3, acquire real inflation-resistant assets. Stop buying liabilities and start buying things that actually hold their value long-term. Let's break down that first step for a second. You can execute your war on debt using one of 2 main strategies. First, there's the debt avalanche method, which targets the highest interest rate first. Now, this is the path that mathematically saves you the most money. Alternatively, you've got the debt snowball, which targets the smallest balance first. Sure, actually, scratch that. It doesn't make perfect mathematical sense, but it builds quick, undeniable psychological momentum. Honestly, just choose the one that keeps you disciplined and execute it ruthlessly. And as you attack that debt, I want you to keep one fundamental truth burned into your memory. Eliminating a 20% interest credit card debt guarantees a massive 20% return on your money. Think about that. It is a completely safe, risk-free yield that absolutely no stock market index fund or real estate deal can consistently beat. Paying off your bad debt is, for sure, your best investment. Then, once your toxic debt is finally cleared, you apply these very pragmatic wealth rules. First, focus entirely on hitting the $20,000 savings threshold. Why 20 grand? Because that is the inflection point where compound growth truly begins to accelerate, and you finally get to see your money doing the heavy lifting for you. Second, follow a strict investing order. Third, prioritize dividend growth to build up that passive income. And finally, and this is arguably the most important rule of them all, stop buying things just to look rich while you are still broke. You gotta abandon the ego and just embrace the math. Look, the financial system wasn't built to protect you. It was built to profit off the interest you pay, which leaves you with a really profound choice regarding the ultimate destination of your paycheck. Ask yourself, will you keep funding the bank's bottom line, or will you use discipline to fund your own freedom? That choice is entirely in your hands. Thank you for joining me for this explainer. If this grounded, stoic approach to mastering your money resonated with you today, hit subscribe so you don't miss our upcoming practical guides on building unshakable wealth. And be sure to check out our shorts for your daily reminder to stay disciplined and stay focused on your freedom. I'll see you in the next explainer.